All right, we've got Justin Overdorff at Lightspeed and Jim Labe at TriplePoint. We are going to dig into fundraising. It's amazing, we've been talking about banking so much. Haven't been digging into getting all the fintechs and everybody else money. So, Justin, I'll just start with you on the equity side. We're not at peak fintech right now. How do you look at fintech investments, either whether it's a Series A, sort of like, oh, we're going to get this thing going, to companies that raised in the peak and now are trying to get more capital?
Yeah, I think it's actually pretty interesting right now. I think you mentioned Series A. I think Series A is actually the hardest spot right now for investors to find opportunities that they're excited about. I think if you look across our peer set, it seems that there's been sort of a bifurcation. Firms are going down to seed, or they're going upstream to growth. And the reason why that I think that mostly that's happening is because on a risk-adjusted basis, seed's a better bet, a smaller dollar amount with the same level of product market fit risk as the Series A. So we're seeing that happen. I think Series A's right now are still pretty hard, and I think companies that raised in the 2019 to 2022 range raise a seed round that will come to raise an A. This year will be very important for them. I do think, though, there's going to be great opportunities, and this vintage, over the next 2 years is going to be a really, I think, interesting time to be investing.
Are you doing a lot of deals?
We've seen a lot over the last.
Okay, interesting.
No. I think we're in the business of.
You have tons of capital.
But the thing is, we look at things through the lens of time. I will make 2 or 3 investments a year, and so I have to pick my spots very carefully, right? So, but I've made 1 investment this year, hasn't been announced, but that's what the pace is right now.
All right, Jim, people know equity a little bit better. Obviously we have some savvy people here, but can you explain non-bank debt just in a couple lines so people get what you're doing, what types of deals you're looking for first?
Sure. I probably should say I wasn't sure I walked into the right summit here because it's banking, and there should be a non-banking summit maybe, but I'm a bit more the minority here because we do non-bank lending to venture startups. We're not regulated, and I don't hope what happened to SVB ever happens again, that kind of a weekend, but somewhat sadly, but fortunately for the non-bank side of the business, there was quite a panic because we couldn't keep up with the deal flow. And it was actually a validation and somewhat benefit of this non-bank category. And we do work with all our brothers and sisters in the room, all the banks as well. But it was kind of an interesting boon. I think your question was in terms of today's...
So bigger than sort of a venture debt that I would get from a bank, or what are the characteristics of the debt deals that you're doing?
Yeah, so we could even start with the fintech space. So it's slowly but surely, our observation is Series A and B deals are starting to pick up. But where are the warehouse lines? Where are the things that would be done by the commercial banks in pre-COVID and pre-SCB? And so there's this various voids and gaps, I know that word keeps coming up, in the marketplace for non-bank lenders there, which is, here's a pre-revenue company, here's a company hasn't yet put together its first loan or loan book, but we're doing warehouse lines, those kinds of things. So there's opportunities.
And are a lot of the deals coinciding with venture rounds? Are they so people can procrastinate venture rounds? Or what's the timing of the debt relative to equity?
Yeah, that's a great question. So our form of debt is ideally to enhance and supplement the equity that's being done. A big no-no in the industry is we are not a replacement for equity. So quite a pipeline these days, but there's a fair number of companies which are having difficulty raising capital or failed equity rounds. That's not the time that you then call your debt provider and turn to debt as the substitute.
Equity is sometimes competitive with debt, so there's an incentive for VCs to be skeptical of debt, but there is some legitimate skepticism from venture world about raising debt. Or what are your thoughts on when to tell your portfolio companies to get debt versus not?
Yeah, I think when you think about equity and debt, they're financial tools. And like any other tool, there's a time and the place for those tools. And if you use things incorrectly, you're going to be in a bad spot. I think venture capital is a great example. Not every company should raise venture capital, right? And venture debt, we partner very well with firms like Jim's. And the reality is there are cases where debt doesn't make a lot of sense. And I think you have to be very thoughtful about when you bring debt onto a company. And he just hinted at it, like there are times when it doesn't make sense. And so the challenge for us is, how do you help your portfolio companies think about that, and how do you help them make decisions that aren't going to put them in a place that puts them in a bind? The reality is, when we think about debt, it sits first on the pay stack, right? It's the first thing that comes out. And the business that I'm in is I can take principal risk. He can't take principal risk. He cannot lose his money. So when the rubber hits the road and there is risk of losing money, they have to be in a situation where they have to take actions to protect their principal at all costs. That's their fiduciary duty to their investors and how they're set up. We can lose money, and it's okay. It's not what we like to do. So that has repercussions, and those repercussions are things like, warrants and covenants and things that put companies into very difficult spots.
When do you have to take action, or what would you say is sort of the fear of the downside being harsher when companies raise substantial amounts of debt?
So debt, some people say, is a four-letter word and a necessary evil, but at the end of the day, it's about finding the right combination of equity and debt and optimizing, call it the cost of capital and the dilution. I would say to have too much debt is very, very dangerous, but also to have no debt, I would contend, is equally dangerous. And so it's finding at the right stage, the right time and place, the right mix there. So things we're always looking at is, I'm sure the banks as well, debt to equity ratios, who's the investor behind this, and where in the developmental stage is the company. But I'm sure there's a place. We work with a lot of Lightspeed deals, but there's always a little bit of contention between equity and debt and where in the stage do you employ it. I would say we're far less dilutive than Lightspeed. On the same hand, yes, we do like to get our money back. We don't always. I hope it's true at Lightspeed deals, by the way.
What percentage of the time do you get your money back, or what's?
Yeah, so it's going to vary. We've done this forever. I've been through 7 cycles, and at the end of the day, when a company doesn't fail, it doesn't work out, it generally tends to be, well, we've gotten some amount of repayments at that point in time. It never happens the day that they take down a loan, and there's usually some amount of recovery, and it can vary. Oftentimes there's some soft landings, some acquisitions, a debt stack goes out first, we'll have full recovery. Other times, maybe we've gotten 50, 75% of our payments back, and there's some enterprise value, collateral equipment value, but I mean, we don't cite exact percentages, but I'd say it's similar to middle market or commercial lending in terms of percentages that we don't get it back.
Justin, I wanted to take it a different direction. A company that I don't think has come up today, but looms super large in the fintech world, Stripe. I mean, the Collisons put out their letter reflecting on the business. I'm just curious, what lessons you take from, I think, sort of the resurgence of Stripe at the moment. They're sort of strongly cash flow positive, and what lesson that takes for fintechs and which companies you're targeting to invest in.
I mean, I think maybe at the very, very 30,000-foot view, I think Patrick and John are incredibly patient founders. So I think patience is one of the lessons here. I think in 2022, the narrative was sky is falling, everything is fucked, and
they missed their window. They should have gone public when they could have.
Yeah, and so look, it's understandable. People are pretty reactionary, and if I worked there for almost 6.5 years, and Patrick and John have never wavered with their sort of approach, not once. And so they were just operating as if it was a Monday or a Tuesday and it was any other day. And so I think that's the lesson a lot of founders that are earlier in their career that they can take away from it is you have to have conviction on the path that you are on, and short of there being something existential, having a steady hand is a really key asset. So that's one thing. The other thing I think for the broader fintech, what does it mean? I think the reality is this, it is so clear that I think in probably 2015 to 2022, fintech was largely overfunded in many ways. And so I think the reality is the last 2 or 3 years have been a reckoning of that. And so now we're at a place where things I think stabilize. The market is going in the right direction. People are feeling confident-ish. And so, I think that's Stripe is a bellwether, and I think it's going to probably, the reaction from investors and founders is that things are back to normal. Whether that's true or not, we'll see what the next year looks like in terms of rates and things like that. But
Jim, are you doing many fintech company deals right now, or are you seeing a lot of deals where you're investing?
Yeah, we're seeing a slow, I'd call it a slow and steady increase in a number of different sectors that are in favor these days. There's obviously been some sector rotation post-SCB as well as in the markets overall. So fintech is one of the more robust areas. We're seeing a lot of Series A and B in particular, definitely a pickup in that, slow and steady.
I wanted to go back to something you were saying earlier about the crisis. We started everybody else out with the crisis, but yeah, talk about the business that you were picking up as SVB unwound. Like, how did you decide which loans to cover? How did you think about how to react?
Well, it was a function of how many of the phone calls we could get to in return, and I don't want to sound like it was overwhelming, but it was. We had our whole team. We all have stories of that Thursday through us Sunday and Monday, and I won't get into my stories, but I'll say we had our whole team, most of the company, that was working throughout the weekend, and we're global. So I'm still trying to figure out where anyone can sleep on a global schedule. But the business was strong, and we were talking, putting loans together for some venture funds and some very short-term payroll loans. And our customer.
Is that typical? Do you do a lot of venture fund loans, or was that unique to that situation?
That was very unique. That's once in a time, a lot of management companies. The good news is a lot of them didn't end up needing it, but some of the venture funds, SCB was where all their funds were, and many of their portfolio companies, we know all their funds. So it was an interesting time.
You know, we hear a lot of pronouncements about what the banks are doing. What's your view on, if I go to one of the banks for venture debt right now, how the prices compare to the heyday of Silicon Valley Bank and First Republic?
Yeah, no, there's definitely been I guess in my view, a retrenchment on the debt or lending side. There's a lot of activity going on in the commercial bank side, and you know, there's a time and place for bank and bank services and credit cards and things we've been hearing about, but there's been more of a separation between some of the banks and lending. And so that's what's creating an opportunity for the non-bank lenders like ourselves, like there's never been, because you don't need to do a loan with your bank necessarily. Now, having said that, we work with all the banks, and in a number of cases, they have a line from us and a line from a bank. But definitely with those two banks, there's been some rotation and examples of a number of examples where we've taken them out. The landscape's changed for debt, and I think somewhat permanently, because there's the emergence a little bit more of this non-bank category for your lending, and your bank for investment management, cash management, a lot of what the banks do really well, not necessarily some small amount of lending here and there as part of a package, and then some great equity.
Well, right.
as
There's this argument that if there's a breakdown in relationship banking, if I'm keeping money in multiple accounts anyway, I don't want to have to put all my deposits largely in one bank, then I'm already predisposed to say, well, I'm going to shop around, and if I'm shopping around, I'm open to going to a non-bank. That's sort of the argument for
that.
food.
Plus, you don't necessarily, especially post-SCB, you see what can happen even with some of the biggest and best names in the venture banking space. You do not want to be dependent on just one source for, I'd say, anything across the board.
Justin, let's talk themes for a second, or what are you interested in terms of totally new fintech companies? Where do you think people should be building?
I'm spending some time in a couple areas. One I like to talk about is just wealth in general. We think about this in the context of, it's no secret, massive tailwind that's happening is going to be the baby boomer transfer, $70 trillion worth of assets. But we think about it in terms of like where is that transfer going to be happening? It's sort of in 3-4 main buckets. The first bucket is tradable securities. The second is single-family homes. So basically 60% of all single-family homes are owned by someone over the age of 60 in the United States, which is kind of crazy when you think about it. And then the other category is small businesses. So we think about those buckets of where the wealth sits today, and how are those assets going to move around over the next 30 years and change hands? How can we facilitate How can we invest in companies that are facilitating that, riding those tailwinds, building tools for those tailwinds? So that's one area that we're spending in. The second one, I think, is just major theme. We're at a banking conference. Risk is a really, material sort of area for us. We have an investment in a company called Alloy that's KYC, AML orchestration layer. But we think about this in the context of fraud and risk has become a global business. It's no longer, a couple people that get together on the internet and decide to steal some money. It's nation states, organized crime syndicates. It's a massive, massive global operation and is happening at scale that I think most people don't really understand. And financial institutions are not prepared. They do not have the tools. They will not say that publicly, but they do not have the tools. And so we are very interested in companies that are building tools for those individuals to fight it. And I think the AI trend, synthetic identities, only makes this worse. And so how is AI going to be used as a tool to fight the fire that it's creating?
I get so many fraudulent text messages. The banking as a service, I'm curious, we see a lot of people on stage. Some have banking licenses, some don't. Some act as banks. What's your view on sort of the need to be integrated, to be the bank versus not?
So I think there's a world where there's a bifurcation. We, I think, are seeing companies that have the banking charter and are building software stacks and maybe thinking about the world as being a bank first and building modern software. That's one end of the spectrum. And then I think the end of the spectrum is old school, incumbent financial institution, built on COBOL, shit stack, and hasn't really been able to think about how to build software, but has a license and is maybe trying to be friendly to fintechs, and mostly in most of those situations is screwing up the compliance aspect and putting people in kind of rough spots. I think anything in between is a challenging space sometimes, but I think the most important thing is being a steady hand, focusing on compliance, focusing on how to build your business the right way. There are folks that are going to be on this stage that have a certain focus on that, and I think that's highly respectable because that's the right way to build a product and build a business in this space.
I started off the day sort of talking about this. The 2023 to 2024, Jim, I'm going to ask you first. Is this year going to be busier, better, higher valuations, or what's your read right now on 2024 in terms of the business of Silicon Valley?
Our view pretty much is, having been through 7 different cycles already, that this is another cycle. And venture capital, like all business, is cyclical. And the belief is pretty much here heading into 24, can't be as bad as 2023, hopefully. And there's a lot of dry powder sitting on the sidelines with our venture capital funds, and it's ideal to deploy it because that's the objective. And we're starting to see, as I said earlier, slow and steady pickup. It's a little bit more at the earlier stages. It's companies that now have plans to head to profitability in interesting sectors than those of the past, as well as no more of this, call it growth, as being the objective.
I'm going to open it up after this. Your read on the mood.
I think people are, we've watched the public markets have obviously, the sentiment there is rather positive. I'm a little bit more maybe broadly pessimistic. I think we'll probably have some air pocket in the next 12 months. And how fast the Fed reacts to that air pocket and how sort of maybe severe they react to it is going to have some very, very large downstream impacts on everybody in this room. And so we'll see. But I'm cautiously optimistic, but a little bit scared.
Questions?
Hey, we're off with the American Politics Company here. It's a question for Justin. I guess wanting to ask you not about pitch advice itself, but for the pitch process. Other than coming to elite summits and rubbing shoulders with suits, how do you recommend I set it up so that it's not just one of your hundreds of deal flow?
I think it's all about relationship building. I think my peers in this room would probably agree. It's about building a long-standing relationship. I think bad behaviors were built in the 2020 to 2022 timeframe where, founders would kick off a fundraise and sort of basically say you have a week and a half to make a decision. You're either on board or get out of the way, and that's a pretty bad way to build a long-term relationship. So I think the advice I give founders is think about relationships, think about how to build a cadence with people so that it's a familiar conversation, not the first time you're meeting them when you're actually asking for money.
Great. Jim, Justin, thank you very much.
Sure. Thank you.
All right.